Welcome back, everyone. We are thrilled to have you here for our final session of the day, where we're going to hear from a couple of our colleagues from the New Covenant Trust Company. Just as a reminder before we get started, this session will last about 45 minutes. Following the session, we will have a very brief break, maybe just 1 or 2 minutes, and then we will have an opportunity for a Q&A based on the questions that you have submitted in the Q&A box. If you have questions during this session, please continue to submit those, and I'm gathering all of the questions that are submitted so that we can ask our panelists to expand on some of those things when we get to the end of the day. Right now, what I would like to do is welcome Brad Masters, who is the Vice President at the New Covenant Trust Company, and James Carey, who is the Director of Investments at the New Covenant Trust Company, to come on the screen, unmute, and I am going to turn it over to the two of them to talk to us more about understanding investments and what that looks like in today's world. Welcome, Brad and James.
All right, thank you, Maggie, and all for sticking with us through the day. Good afternoon. As Maggie mentioned, yes, Brad Masters, James Carey is here with us as well, and we look forward to spending a few minutes with you here to talk about principles for investing success. I'm going to take the first few of our slides. James is going to drive these for us and then hand it over to him for more of the investment heavy details. And then I'll come back at the end to wrap things up for us. So look forward to this time with you. James, let's proceed. Just a quick couple of moments here to better introduce you all to the New Covenant Trust Company. You know, our call is to empower faith-based organizations, churches, church institutions, and individuals that are connected to their local churches by creating and sustaining healthy and vibrant ministries. This has been our call since we were founded in 1998 as the wholly owned subsidiary of the Presbyterian Foundation. We are technically, from a regulatory standpoint, we are a nationally chartered, limited purpose national bank regulated at the federal level by the Office of the Comptroller of the Currency, also referred to or known as the OCC. And again, since our founding, our priority has always been the same, which is to take care of each and every client that we are fortunate and called to serve, no matter the size of your account. And I believe I know that several of our trust company clients are gathered throughout the country in various places listening to this. So thank you for participating and again, for your trust that you've placed in us. Our services, again, sort of who we serve and how we serve, our philosophy and approach. Again, everything that we do is driven by our shared faith, shared values, and the integrity of the PCUSA. We've got a team of about 18 professionals that can provide expert guidance on matters related to long-term visioning and strategy development. We provide investment advice, help with investment policies, other governing documents as appropriate, well-versed in matters related to portfolio construction and portfolio management. We offer and provide a wide range of values-based investing options. You can see the list here, portfolios that are consistent with General Assembly guidance as expressed through the Committee on Mission Responsibility through Investment. We have investment strategies that are specifically geared toward supporting and lifting up those that are focused on diversity, equity, and inclusion, as well as fossil fuel-free investment portfolios. I'd also like to point out that we're able to build, standard or portfolios that aren't screened. At the end of the day, we want you to know that the work that we do, the portfolios that we would hope to build and manage for you are customized to your specific values, and again, which are consistent with your mission and ministry plans long term. You also see here that as we can serve individuals, we provide charitable trust services. We provide endowment management and are able to also then offer financial gift and estate planning services to individuals, as well as serve those donors who perhaps have interests in what are known as specialty assets, oil and gas, farm and ranch, timber properties, those types of things, how to help donors gift those types of assets to your church, and then subsequently how to help a church receive and administer those types of gifts. Love to talk to you more about that. Again, just before I hand this over to James, we want you to know that, as partners in ministry, you're a lot more to us than just an investment management client. There are a lot of resources that we hope and desire to bring into your lives, again, as individuals, as well as churches or institutions. because we are part of the same larger church family as you are. So there we are. I'll come back at the end to provide some closing thoughts on behalf of James, myself, and the trust company. But for now, let's dive into these principles for investing success, and I'll hand it over to James Carey.
Great. Well, thank you, Brad, and hello, everyone. So good to be with you. Thank you, Maggie and Steve, for putting on this event. I realize I'm the last speaker after a long day, so I'll try to keep the energy up here, but really do appreciate you all being here, appreciate your attention. And as Brad mentioned, we'll be talking about, principles for investing success. If you're going to be an investor, we believe these principles are important. And the primary reason is because as humans, I think similarly to our spiritual life, some of our human nature has made us hardwired to be lousy investors in a lot of ways. And this chart is kind of a funny way of illustrating that. You'll see that oftentimes we're tempted to, as markets are going up and we feel like we're missing out and we're hearing about people making money in markets, that's really when we most want to buy. We have the strongest urge to want to get in and buy and participate, towards the top. Similarly, as things are going down and we're really worried and we're listening to the news and we have all this fear, that's when we're most inclined to sell. So these principles are really meant to protect us from making bad decisions as investors. And it's really those emotional decisions that can be some of the most damaging as investors. So these principles are really meant to give us that foundation, that baseline to be successful investors, especially in the storm. So we'll jump right in. And principle number one is investing should start with goals and time horizon. It's really important that your investing journey starts with you figuring out the goals, the time horizon, and the risk preferences associated with your investment. What are you or your ministry trying to accomplish or achieve with this investment? It's a critical question to start with. I was considering, today the GPS on our phones and how it's amazing here in 2022. The GPS knows so quickly when there's an accident and when traffic is backed up, and it can change so quickly to do the fastest route now that there's traffic backed up here. And it's just amazing for people in the past to maybe consider the sort of GPS capabilities that we have here in 2022. But if you don't have a destination to put into your GPS, then it's really not going to do you any good. And so similarly, as investors, and Anita's presentation was great, showing all the different options that you have available today as an investor, but you have to know where you're going to know what sort of investments will be best for you. Investing without clear goals often leads to things like collecting five-star funds that maybe don't have much cohesion with one another, portfolios that aren't necessarily efficient in terms of having some assets that will zig while others zag and that sort of thing. So step one is starting with goals and time horizon, and then you can begin to really determine whether an investment is good or appropriate for you. Some examples of goals. So you may have a goal such as supporting a spending level of 4% in the account, a typical endowment style investment mandate. We tend to believe that spending levels of 3 to 5% are most appropriate for long-term endowment style goals. Maybe you want to achieve growth that keeps pace with inflation. So real growth net of inflation, you want this account to grow over time. Maybe your goal is stable value or safety. So most of all, you want the money to be there when you need it in a couple of years. Maybe there's a capital project or something you're doing 2 years from now. Most of all, you want it to be safe, and then you want to earn any interest or income that you can alongside that. Sometimes, again, goals include things like you want your investments to bear witness to the mission or the values of your ministry or your congregation. So all these things can be included in the goals. Time horizon, pretty easy to understand, short-term, medium-term, long-term. When are you going to need, how long can this money be invested to where you don't need to touch it? And that's a critical question to ask as it relates to how much risk, how much of the portfolio you can put into risky assets, which really require time in the market to achieve the average returns. You don't want to put money into a risky asset and then need it in a year. If the asset is volatile, it may be down, and that would be an inefficient outcome. So you want to avoid that. So very important to define the buckets of money that you need, those time horizons, and then you can really begin to build a portfolio. So this chart here is really just illustrating that trade-off. So there's a famous saying in economics, there is no free lunch. Everything is a trade-off, everything has trade-offs. And in investing, there's a trade-off between risk and return. And as we go from left to right, the most conservative portfolios of all bonds, all the way to the most aggressive portfolio of all stocks, and everything in between, what you see is as you go from all bonds to all stocks, that average return over close to 100 years now does increase as you increase your exposure to stocks, which are riskier. But the trade-off for that decision is you now have more volatility, and on the top and bottom are the best 12 months and the worst 12 months. So in exchange for higher average returns over the period, you're essentially knowing that in any given 1 year, a balanced portfolio could be down 20%, 25%, 30%. So $1 million could turn into $650,000, $700,000. In exchange for that short-term volatility that is possible, you have higher expected returns on average over the full cycle. And so that's why it's important to really know where your short-term needs are, maybe where your longer-term needs are, and calibrating that portfolio so you can achieve, expected rates of return that are consistent with your goals and time horizon. You're not being too conservative, for example, but you have appropriate levels of risk for each of your time horizons in your investing portfolio. This next slide shows a very similar story, and essentially this is really highlighting why it's so important, especially for the riskier parts of your portfolio, that those are associated with long-term assets. This chart shows that market returns are almost never average. So the average return on the stock market is about 10.5%, but since 1926, only 7 out of the 96 years has the stock market been between 10 and 11%. In 89 years, it's been something outside of that range. So the average is 10.5%, but in many years it's plus 30 or plus 20 or minus 12 or minus 18, and then plus 19. And that's the sort of experience that you may have in stocks. And that's why it's important to be able to be invested for 7+ years, 10+ years, if you're seeking to achieve those higher average returns. To get the higher average return, you have to put up with more volatility. So once you've determined the goals and time horizon, and you've really organized yourself to know what you need in the short term, in the medium term, and the longer term, principle number 2 is it's really the asset allocation decision, that mix between stocks, bonds, and cash, that is the most important decision and explains most of your long-term returns as an investor versus market timing or picking stocks and things like that. And also diversification is a critical component to the process, which helps smooth risk and also helps you achieve more efficient returns. So, again, while they tend to get most of the attention, this chart shows, this is a well-known study that's been replicated a number of times. It really just shows that for long-term investors, that asset allocation decision or your mix between stocks, bonds, and cash explains more than 90% of your investment returns over the long term. Whereas even though they get most of the attention, what stocks you pick or market timing, that explains less than 10% of the long-term performance. So it's really important. We view it as the most critical step as an investor to get that asset allocation decision right, to match those goals, that time horizon that you came up with in step 1, to an appropriate asset allocation to help you reach that goal. And doing that, you're well on your way. Those are really the 2 most important steps. Some examples of that asset allocation decision. So some different asset classes, on this chart from the bottom to the top is expected returns. So as the chart goes up, that's higher returns. And from left to right is risk. In markets, that's known as standard deviation or volatility, variance. So over to the right are more volatile companies. And you'll see, again, that trade-off. There is no free lunch. The higher return assets are also the more volatile assets. And so it's important to really calibrate the portfolio for your time horizon. Short term, you're probably thinking cash, CDs, T-bills, short-term treasuries. And then as you get longer on your time horizon, now you're looking at opportunities to invest in stocks, large cap, small cap stocks, et cetera. Now this chart is really starting to show why we view asset allocation as the primary decision, or why we think it's true that asset allocation is really the primary decision. And what this is starting to show is every single day that the stock market's open, there's hundreds of billions of dollars that are trading hands between thousands of traders all around the world. And there's some of the biggest banks in the world. There's some, there are people who spend their entire careers and every waking moment thinking about markets. And they only want to do one thing, which is make the right trade. And, we believe that all of these billions of dollars and all of these thousands of traders every day buying and selling is an efficient mechanism. Markets are an efficient mechanism to really incorporate all known information, all available data on companies and on securities to come up with prices that are efficient over time. Now, markets can get a little too excited in the short term or a little too fearful in the short term, but overall, on average, and especially over long periods of time, the market mechanism is very efficient at coming up with prices. And to try to outguess market prices or to try to consistently try to outthink the market or outguess the market, we believe is a very difficult thing to try to do. But rather, this asset allocation decision is really the big one to focus on. As we look at some empirical evidence of that notion, we'll see here just, mutual fund managers, and Anita talked a little bit about active managers and passive managers. So this is along the lines of those active managers, empirically, how have they done over 20 years from 2002 to 2021? Well, we look here at 2,800 stock mutual funds, and over the 20-year time period, only 18% managed to beat their benchmark. What was interesting is actually only 44% even survived. So you actually have a much greater chance, 56% chance that your fund isn't even going to survive. It's going to close. It's going to cease to exist before the 20 minutes is up, the 20 years are up, versus actually manage to outperform the market. So again, we think that market pricing mechanism is very efficient. It's very difficult to outperform and outguess the market over long periods of time. And we see the empirical evidence, even of professional managers, their main job is to try to do this. Only 18% managed to do it. Many more of them, the funds didn't even exist following the period. This next chart also just shows why diversification is so important. So this is a sort of well-known chart. You'll see it in various contexts. Skittles chart, this blue sort of turquoise color is large cap US stocks. There's various different asset classes. And you just see how in any given year, sometimes stocks are in the middle, sometimes they're at the top, sometimes they're at the bottom. The sort of charcoal color is real estate. It goes from the top to the bottom, to the top, to the bottom. All of these different asset classes are jumping around every year. And it's really difficult to try to predict which will be the winners, which will be the losers. So it's really important to keep your allocation balanced between each of these asset classes, each of these sectors, remain diversified so that you can participate in the winners and that you don't have all of your eggs in that basket of some of these losers. So diversification is a very important component to the asset allocation process. Principle 3, minimizing costs is a controllable factor that most often contributes to investors' returns. So one of the reasons why we are such big fans of focusing on costs and managing your costs is because it's actually something that you can control, where we can't control the economy, we can't control the Federal Reserve, we can't control inflation, we cannot control markets, but we can control with a high level of certainty what our expenses and what our costs are in the investments. You know exactly what those costs are in the prospectus or as you're researching mutual funds. And by keeping costs low, you're able to keep more of that return in exchange for the risk that you're assuming. You're able to keep more of that return for your investment. And additionally, similar to investing, your costs and any money that you save on costs compounds over time. So a dollar invested today isn't worth a dollar 10 years from now. It's been compounding. And similarly, as you save on fees, that benefit compounds as you stay in a low fee portfolio. As you keep more of your returns over time, you similarly experience the benefit of compounding and benefit from that decision in a compounding way, especially over long periods of time. So this chart really, again, shows the empirical evidence for that. In the red, you'll see the lowest cost quartile funds, and in the gray, you'll see the highest cost quartile funds. And for every asset class, every single asset class in the universe, you'll see that the low cost quartile funds are outperforming those high cost quartile funds. So many of these active funds, you are paying higher expenses and earning lower returns. And these are the types of things that we consider as we evaluate how to be the best investor that we can be. This is the type of evidence that's very compelling in informing some of our decisions and some of our advice in what our principles are for being successful at investing. Lastly, principle 4, once you've come up with your goals, your time horizon, you've really determined and discerned what you want this money to do, you've come up with an asset allocation that's appropriate, that matches that goal and that time horizon with a diversified portfolio that has expected returns that are expected to help you achieve that goal in a way that you're comfortable with in terms of the risk levels. Now, and you've kept costs low and you're well diversified, now it's really important that you are disciplined, that you're committed, that you follow your written investment policy statement through market cycles, through market dynamics, through volatility, through excited markets and through fearful markets, that you maintain that discipline over full market cycles and don't really drift from that policy that you've determined either in times of fear and volatility, or even in times of, well, you want to turn on the risk because the market's doing so well. So, these are the types of decisions that oftentimes our human nature makes us want to consider, but oftentimes that's the worst time to make changes. So it's really important to remain diversified and committed to your plan once you've taken steps 1 through 3 and found yourself in an appropriate portfolio. It is oftentimes that once markets have experienced the sharp downturns, that it's the most ill-advised time to sell out of markets. After markets have gone down 25%, on average in 5 years, they're up 63%. And in 12 months, they're up 23% or something like that. So, oftentimes, once you've experienced the downturn, once you've experienced losses in a bear market, it's often the worst time to make those decisions, even though it's when the urge to make trades or to make changes is strongest. This next chart just shows a little bit of the reasons why we may continually be bombarded with reasons to want to make changes. We read all these headlines, we read about all these people that are doing well in markets, or we're reading about all the reasons why markets are going to be lousy or why we need to, run for the hills or things like that. It's really important when you're, reading the financial news or consuming financial media that you keep all that in your context of your investment plan. Oftentimes, these things are very short-term in nature. The context is, very short-term. What happened on this trading day? What's going on in this quarter? What's next quarter's expectations? And these things can really not be consistent with your context or your time horizon. So it's really important to keep headlines in context as a long-term investor, because we can't avoid them, but it's important to really understand how they matter or how they fit in to your specific context as an investor. A famous example of this, a Business Week article from 1979, The Death of Equities, How Inflation is Destroying the Stock Market. This was a cover piece from Business Week, a multi-page article, and markets had been pretty lousy for about a decade over this time. And the article was all about how, because of interest rates, because of inflation, because of these new real estate investments that were available, stocks were no longer the place to be for investors. There's all these other options. There are these better options. Stocks are over. It's a new age, and it's the death of equities. Well, the thing about that article was it preceded almost immediately one of the great bull markets of all time. Investors who dumped equities following that article in 1979 would have missed a 1,117% return that began pretty soon after that article was published. It's a 13% annualized return. I think $10,000 grew to like $150,000 or something like that. So you really need to keep it in context, or keep, take everything with a grain of salt as it relates to, the financial advice of, publications and things like that. Another chart that we really like, especially during this time of some market volatility, is this chart, which again shows the context, shows sort of the zoom. Sometimes we really just need to zoom out as investors. The zoom that we think is really important, especially for long-term investors. This shows $1 that was invested in the global stock market from 1970, so about 50 years. And you'll see that this $1 that was invested in the global markets in 1970, despite multiple crises, multiple bear markets, a number of recessions, double-digit inflation, here's the Death of Equities article, a savings and loan crisis, Y2K, 9/11, the dot-com crash, the tech bubble, Hurricane Katrina, the Great Financial Recession, Eurozone debt crisis, fiscal cliff, Brexit, and COVID. Despite all those things, multiple recessions, multiple bear markets, that $1 grew to $98. And so we really do believe that it's time in the market. It's not timing the market, that it is remaining disciplined in a long-term investment that's appropriate for your needs and your goals, but really, letting your investments work for you, letting the capital markets, letting the global economy work for you over long periods of time, not trying to outguess all these different things, not trying to expect, some of these crises or expect how they're going to play out, or time this, or, get in and get out. These types of things tend to lead to inefficiencies. And we see that empirically in investor data versus their investment data. But, really letting your investment work over long periods of time has been shown empirically when you're diversified in an appropriate asset allocation with low fees. These are the things that help you achieve success, the most reliable way to achieve success as an investor. So again, as we sort of just put it all together, being on the investment journey, we believe it's really important to get steps 1 and 2 right, and to spend your time there. Sometimes people spend all their time deciding whether Coca-Cola is going to outperform Pepsi, or whether it's Delta Airlines or American Airlines that they should buy stock in. But really, getting steps 1 and 2 right are the critical steps to success in our view. So step 1, prayerfully and very intentionally discern the goals, the time horizon, and your risk preferences for your investment. What do you want and need this investment to do? And then most of all, document that in a written investment policy statement for ministries and for churches. This is really important as volunteers or committees or staff, change over time. You want this documented, you want this written down in an investment policy statement, and that can help you in times of emotion, times of fear, and in times of volatility. Once you have that determined, construct a broadly diversified portfolio with an appropriate asset allocation of both risky and safe assets, depending on your time horizon, depending on your goals, that'll help you meet your return goals and your risk preferences. Don't try to outguess the market. Don't put all of your eggs in one basket, but really, focus on the diversification and that asset allocation, matching your needs and your goals, and focus on that. Engage a financial professional here if it's appropriate. A financial professional is time well spent, again, for this step that we think is critical to maybe the beginning of a 10, 20, 30-year successful investment. Getting this right is very, very important. So don't hesitate to reach out to the foundation or reach out to the trust company if we can help. Once you've done that, do that in such a way that you're keeping your investment costs low so that you can keep more of the returns that you earn for, assuming that risk of markets, it's well-earned return. So you don't want to give as little away of it as you can to investing costs and mutual fund expenses. And then remain disciplined and invested over full market cycles. Maintain that context during times of volatility and when consuming financial media. Keep that, whatever that context or that zoom is for your goals and your time horizon, keep that in context when you're reading about today's market action. Or the Dow, it plunges or it surges, plunges 800 points or whatever it is. Keep your context and your zoom as appropriate when you're seeing headlines. And finally, we view it as important to just let your investments work for you and focus on what's most meaningful or important to you. For many of our investors, that's your mission, that's your congregation or your ministry. Let the investments work. You're invested in the global economy, the global market. Every day, people are waking up and going to work and participating in the global economy. These companies are making products and selling products. Your money is working, your investment is working every single day. You don't have to follow every news headline or be on top of every stock or anything like that. It's really, let your investments work for you and focus on what you do best. Focus on your congregation or whatever it is that you're doing in ministry. We think that's important just to help you avoid making mistakes, making emotional mistakes or, knee-jerk reactions, but also just maintaining a healthy context as an investor. So hopefully those are helpful principles. We're looking forward to following up with anybody on questions and that type of thing. But really do appreciate your time. Thank you for being here this afternoon. And thank you again to Maggie for putting on the event. So I'll turn it back to Brad, but looking forward to seeing the questions and helping you all anytime that we can. I'd be happy to do so.
Thank you, James. Everyone, just our last couple of slides. Again, the tremendous information provided throughout the day by Robert, by Anita, by James, and others along the way. We certainly know and understand, right, that there's a lot of things to think through as you contemplate sort of, a journey toward investment success. And we want you to know that you don't have to do all this on your own. As we've said today, engaging a financial professional that's also a fiduciary can add tremendous value by assisting you through, thinking through these things, executing these steps, being a good partner to you along the journey. And also as people of faith, we would also encourage you to seek a professional that knows and understands and shares your values and understands your mission. This graphic really just helps you better understand what we would seek to bring into the conversation, the engagement, the 4 C's of financial professional as a ministry partner, looking for a group that is competent, right? That has been about this work, that knows investments, that knows the church, that has the educational background, the experience, the designations to serve, that also can provide some level of convenience. The idea of working with a single point of contact can be tremendously helpful along the way. Consistency in reporting and communications can be critical. A partner that provides coaching and education, brings additional resources along the way, best practices, things that we have learned in our case through serving other churches and mid-councils across the country for many years. And lastly, the continuity. We know that through serving churches, we're often dealing with the rotating group of committees, session members, boards, elders, trustees, what have you. So having that continuity, the institutional memory, as things change there locally for you, we would also think is very important. So just to give you our contact information on our last slide, I wanted you to certainly know how to reach us directly in the trust company, or certainly through your ministry relations officer through the foundation's website, presbyterianfoundation.org/ MRO. So again, on behalf of the trust company, James, Carey, myself, and others, thank you again for the opportunity to present to you today. So Maggie, all set. Thank you.
Thank you, Brad. Thank you, James. That was great information. I think that it's good information that a lot of us need the details of what it means when we're thinking about our investments. James, I really appreciate that reminder to not be reactive, but to think about the long term. So thank you both. We really appreciate having you here. We're going to take just a very brief break, maybe a minute or so, while we make some technology changes on the back. We invite